Hi everyone and welcome to Investing in Canada. The objective of this course is to help you make your investments in the most efficient way. In this topic, we are going to talk about creating your investment portfolio using ETFs. So this whole course is available under Investing in Canada on Udemy. So links are in the description. Please check all the videos that are available on Udemy. Okay, some free videos are available on YouTube also. So the YouTube channel is EduFin Wizards. So if you're new, please subscribe to us so that you get regular updated videos. Like and also comment because it helps the algorithm. Okay, so we'll start with the topic of what are ETFs. So ETFs are similar to mutual funds. So what happens? Different investors pool their money, they accumulate their money, and they give it to an ETF company to manage it. So it is similar to mutual funds. In mutual funds also, investors pool their money, they accumulate that pooled money, and they give it to an ETF company to manage that money for investors. Then that ETF company invests in different instruments like stocks, bonds, treasuries, real estate, and crypto. So an ETF could be combination of these, or it could be stock specific, bond specific, treasury specific, real estate specific, etc. So how it works? Investors pool their money, they give it to an ETF, right, that manages money for investors, and that ETF, that exchange traded fund, right, puts that money in either stocks, it is a stock ETF, then bonds, bond ETF, treasury ETF, real estate, cryptos, etc. Okay, so that's how it works. So you can buy the ETF rather than buying these individual things where you get basket of stuff. So what are features of ETF? The features of ETF are they are bought and sold on stock exchange using your investment dealer. So your investment dealers like RBC Invest or Wealthsimple, you can go into those accounts and buy and sell ETFs. Okay. A big feature of ETF is since they are traded on the stock exchange like stocks, they can be added into your tax-free savings account, RRSPs, RESPs, first house savings account, and other registered or non-registered account. So like you can add stocks into your TFSA, RRSPs in your TFSA, you can add ETFs also in your registered accounts. So either you can invest in TFSA where the growth and dividends are tax free, or you can get tax deductions by investing in ETFs if you add them into an RRSP account. Okay, a big feature of ETF is it is an instrument that generally tracks an index. So it doesn't have an investment thesis. Most of the ETFs are passive, in which it means that they track a basket of index. Example, there is an ETF that will see XIC. So XIC is a broad Canadian ETF. It means all the stocks that are all the big companies in Canada that are listed, right? They create an index out of them, right? And index is nothing but a basket of stocks. So that ETFs invest in basket of stocks. So when you buy an ETF, you get a claim on that basket. Okay, so it's a basket that you get a claim on. So it generally tracks an index, it generally invests in an index. You can invest regularly by buying set number of ETFs every month, or you can buy in big chunks also, right? That is an flexibility that is available. So let's see a few examples of ETF to understand more. So the first ETF we are going to watch or going to look at is XIC. So it is iShares Core TSX Capped Composite Index ETF. So this is an ETF that seeks long-term capital growth by replicating the performance of S&P TSX Capped Composite Index net of expense. It means it broadly tracks 240 odd companies, big companies in Canada. So when you invest in this ETF, when you pay let's say $31, right, approximately $31 for this ETF, you don't get a stock, you get a basket of stocks, right? How much? You get 237 stocks. Okay, that generally represents the big Canadian companies, right, that are there. So it generally you invest in big Canadian companies. So that was in stock ETF. This is an example of a bond ETF. So BMO Aggregate Bond Index. So the symbol is ZAG.TO. So it has an objective of replicating to the extent possible the performance of, right, Canadian Universe XM Bond Index. So it generally invests in broad Canadian corporate and government bonds. So security held in the index are broad measures of Canadian investment grade fixed incomes consisting of federal, provincial and corporate bonds. So if you invest in this ETF, you're not getting stocks, you're getting a basket of bonds. Okay, those bonds are generally federal, provincial and corporate bonds. So one thing I missed out, if you invest in this ETF, the stock one, you get capital appreciation over the years, the possibility of that if the market does well, as well as you get a dividend. So yield that you see 2.81%, that is the dividend that the ETF provides. Same way, in this bond index, you might have capital appreciation if the bonds are not doing well right now because of increasing interest rates, but you have a possibility that they might rise from here. And also there is yield. So 3.52% is the fixed yield that you get every year. You might also invest in something like a treasury. So this is an example of a treasury bond. So it is a US treasury bond index. This ETF invests in basket of treasury securities. Treasury means government securities. So this is a short-term US bond index that has been designed to replicate the performance of Barclays US Treasury, which is 1 to 5 year bonds, right? So treasury bonds, it invests in US government bonds. The fund invests in variety of US treasuries, primarily with a term to maturity between 1 to 5 years. Okay. This is an example of a REIT ETF. So it invests in real estate companies, real estate REIT companies. So if you haven't watched the video of what are REITs, in a previous video we discussed what REIT companies are. But just a high level remark, REITs are property management companies that manages property and they share rents with investors. So this is an REIT index. So it invests in REIT. Okay. So it tracks a REIT index. So it is an index. It consists of Canadian securities that fall within the real estate investment trust sector. So these are property managed companies that this index invests in. So when you invest, you have a possibility of capital gains if the REIT index rises, and you also get a dividend of 4.74%. Now there are fancier ETFs too. Example is Purpose Bitcoin ETF. So this ETF tracks prices of Bitcoin. So investors can buy this ETF in a TFSA and RRSP, or this ETF purchases physical Bitcoin for investors and then they own that Bitcoin. Now advantage of using ETFs to invest in crypto is you can add them into your TFSA. So it can be virtually tax free if BTC perform, that is Bitcoin performs really well and you grow your money a lot. That might happen, that might not happen, but if it happens, then if it is in your tax-free savings account, you don't have to pay taxes on that. Then the next topic that we are going to address is what is the difference between ETFs and mutual funds. So we are going to look at active way of investing and passive way of investing. Most mutual funds are actually active. So mutual funds take an active approach to investing. They decide what to buy and when to buy. So there is a lot of security analysis and market timing. So when you hand your money to a mutual fund manager, they generally do not invest in an index. Their objective is to beat an index. So how do they go about it? They do their own stock selection criteria as they try to time the market and invest to make money. ETFs are different. They take on more of a passive approach. They invest in an index and the returns depend on index construction. So there are exceptions though. There are index mutual funds that track an index, they invest in an index, and there are active ETFs also that invest more actively. But on a broad theme basis, mutual funds are generally passive, mutual funds are generally active, and ETFs are generally passive. Now a big difference is fees and commissions. The management expense ratio on a mutual fund is generally around 2%. It means if you're investing some money, every year they're going to charge 2% of the fund value you have with them. So let's say you invest $1,000 with them. So first year the fees are 2%. So 2% of $1,000, that will be like, let's say $20 will be the fee. Okay, next year let's say it goes your fund goes to $1,200 because the market goes up, so then they will charge 2% on $1,200. That is how an MER is calculated. It is calculated on the basis of how much you have invested with the mutual fund company, right? So MERs in mutual funds are generally around 2%. They can be lower, they can be higher, so fees are generally higher. In an ETF, the fees are generally lower. The MERs are between 0.25% to 0.75%. Now, MERs are nothing but fees that the mutual fund companies charge. Now, one important thing, generally, right, around, like if you see in a 20-year period, right, large cap mutual funds, 94% of them underperform an index. So you're paying higher to get a mutual fund, suppose thinking that it should beat the market, but most of them do not. So 94% of them over a long period of time do not beat the market. So this shows like whether they how much percent are able to, like how much percent are underperforming the market. So in a large cap situation, 94% of them underperform, so they don't add value. Also, indexing wins most of the time. So S&P index has performed better than most of the mutual funds over a given period of time. Short term though, mutual funds can do better, right, than an ETF, but over a long period of time, generally index does better. That is, investing passively using an index and paying low cost generally outperforms active investing. Now, this is a topic that we are going to address. So this is my approach of using ETFs to invest. So I believe in something called as a core and a satellite portfolio. So core portfolio is where 85% of my investments are. So 85% of my own investments are in my core portfolio. So objective of core portfolio for me is to invest every paycheck that I get. Regularly, bi-weekly, I make investments. The objective is for long term. I don't play short term in my core portfolio, and I use tax-free savings account, RRSPs and RESPs to invest for my core portfolio. Now in my core portfolio, I only have 2 ETFs. I don't like overcomplicate things. I keep it simple. I have GIC, which is the broad Canadian market ETF, because being in Canada, I want to get exposed to the Canadian market growth, and I believe in long-term vision for Canada. The fundamentals over a long period of time have remained good. So GIC is my holding in the broad Canadian market space, and along with that I hold VT. VT is the global equity fund. So 85% of my whole portfolio is into 2 ETFs, stock portfolio, broad Canadian markets and global. The objective of the core portfolio is to bring stability and long-term growth, right? So irrespective of market is going up or going down, I keep on investing, and I invest bi-weekly. Then satellite portfolio is 15% of my holdings. So 15% of my holdings, I actually try to outbeat the market or outcompete the market. So I try to buy when the things are low. So I believe in a contrarian approach. When everyone is buying, I generally stay away. I do keep on buying in my core portfolio, which is regular investments, but to time the market, I try to avoid when people are buying. When we discuss technical analysis, we will discuss more on how to go about it, simple ways to go about it. So 15% of my holdings are tech stocks. So when tech stocks go down a lot and I believe in the fundamentals of those tech stocks, I buy cryptos, emerging market funds. Especially I love XID, that is India. I believe in the long-term story that India has, because it has a lot of demographics advantage, and like Ray Dalio says, demographics is destiny. So I do believe in long-term vision of India. So India is a big part of my emerging market portfolios. Also I have some China and some other countries that are accounted to the developed markets. Then I invest in leverage ETFs. So we'll talk about what leverage ETFs are in the next class, like TQQQ and UPRO. So this is like, it gives you multiple times the returns of the market, but you are exposed to multiple times risk too. So if the market goes down, you lose a lot of money, but if the market goes up, you make a lot of money. So that is somewhat where I play my lottery. So I do not pay any lotteries or anything. So whatever lottery money I have in my mind, like the kitty of that, I put it in a leverage ETF when it is down a lot, right? And then there are covered call ETFs that I invest when I think that market it will, like, it has good dividend potential, but the stocks might not rise that fast. So in that case, I do buy some covered ETFs, like utilities. I have a lot of covered ETFs there. So that's how I structure my portfolio. Core portfolio, long-term growth. I expect just 7% returns on my investments here, right? Because the long-term expectations on stocks have gone down. Stocks used to give 10% plus in like last decade or so, but the long-term expectation, because we had a big market run, right? When the market goes up a lot, the future returns go down. So the long-term expectation is around 7% now. And I invest also in satellite. I try to invest in all of these. All these things like leverage ETFs, covered ETFs will cover in the next video on ETFs. Okay, so that's it for today. This was my investment strategy. It's not an investment advice. This is how I do it. So if you are interested, the whole course is available under investing in Canada under Udemy. Some free videos are available on YouTube, not all of them. So the YouTube channel is EduFin Wizards. So do subscribe, like and comment on the video so that it helps the algorithm. Thank you very much for listening. See you in the next video.